Welcome, everybody. My name is Dimitri Iliopoulos. I serve as the Chief Executive Officer of Curi RMB Capital, and I'm joined today by my partner and Chief Investment Strategist, Chris Graff. We're excited to bring you some very relevant and timely content on our views on the economy and the markets. From a housekeeping perspective, if you have some questions that come up that you think about while Chris is presenting, feel free to navigate the Q&A icon at the bottom of your screen. And when Chris is done presenting, we will answer some of those questions. Just to begin, because we know that we have some guests attending this session today that are not clients of our firm or familiar with our firm, I wanted to just provide you with an overview of Curi RMB Capital. We're a registered investment advisor that serves over 3,000 clients across the United States. We have teams that are in 10 offices in 7 different states. And today we manage approximately $14 billion for our clients throughout the country. Along the way, on the next slide, you'll see that over the years, our business has evolved and it has grown alongside the changing needs of our clients. And what you see here on this page and in that picture is that we have the opportunity, we have the resources, we have the services, and we have the expertise of various team members that can help our clients everywhere they are along their financial journey. Today, we're serving individuals, we are serving families, and we are serving businesses as part of our overall firm. The other thing to mention on the next slide here is that on April 1st of this year, Curi RMB Capital celebrated its 20th anniversary. We're really excited about that milestone because we've done that alongside our clients. Our original team started with 14 people back in 2005. We were serving clients that were primarily in the Midwest, in Illinois, and in Michigan. And over the years, as our client base has grown and the needs of our clients have grown, so have we. And today we're really excited because of the Curi and RMB partnership. We feel like we are more stable with our continuity going forward in the best position we've ever been to continue to serve you and your families going forward. So I would like to introduce my colleague and partner, Chris Graff. He serves as our Chief Investment Strategist, as I said a moment ago. We feel like the content that we're about to share is very timely. There's been quite a bit of change and some disruption and a lot of uncertainty in the world over the last 30, 60, 90 days. And we feel that it's really relevant today to make sense of all that noise and what that would mean personally for your own financial plans and asset allocations. Once Chris is done, I'll come back and we can go over some questions and answers. Thank you.
All right. Thanks, Dimitri, and thanks again to everyone for joining us today. We'll jump right into the conversation. As Dimitri referenced, there's a lot going on since the beginning of the year and even through the end of last year that's causing some uncertainty and disruption in the economy and the financial market and leading to a lot of questions about what to do and how to think about things going forward. So we'll talk about this unusual period of uncertainty. We'll then kind of segue into what's going on in the stock market and risk assets more generally, and we'll conclude with some thoughts about how we were positioned going into this recent era of volatility, this recent period of volatility, and our thoughts on the outlook going forward. So just to start, before we really dive into it and talk about some of the factors that are leading to a lot of uncertainty, we really just want to remind everyone that regardless of the conversation today, regardless of some of the key questions and issues that are tops of people's mind, it's really important to maintain a long-term perspective. So this chart just represents the S&P 500 index going all the way back through the 1920s. And you can see a number of different events that are highlighted along the way related to the red dots or that are on the chart. You can see the gray bars on the chart are also periods of economic recession. And you can see that over really long periods of time, regardless of all the events, all the concerns, the changes, the stock market, generally speaking, continues to march higher. There are periods of time that we'd like to point out here where there is an extended set of years, maybe 10, 15 years, where in some cases the stock market really doesn't move that far forward in an absolute level over an extended period of time. So if you look back to this period from, let's say, the mid-1960s through the 1970s, you can see that during that time period, there was a lot of changes in what was going on in the market environment, and the stock market moved up and down, but generally from one point to another, sort of treaded water over an extended period of time. So as those changes take place, we're highlighting this because we think there's some similarities or some issues that are causing people's concern around this type of environment. But as those changes take place, eventually the stock market sort of gets back on track with a more productive sort of level of returns longer term. But it's really important to remember, again, that we could go through different periods of time where what has worked in the past may not be exactly what works the same in the future going forward. So to put it a little bit more into context for what's happening today, if you think about where we're at, where the stock market has moved since the beginning of the year, this was as of the end of April, it shows annual returns for the S&P 500 in the gray bars going back through the 1980s. And then the red dots are the level of corrections within each of those years, which in each of those annual returns. And you can see that it's quite common, regardless of the level of calendar year returns or the total complete annual returns in any time period, there's more often than not some type of correction along the way. Some years it could be 5–10%, other years it could be 10–15%, sometimes deeper than that, depending on whether we're in a bear market or in a recessionary environment. And then what we've circled on the far right is kind of where we're at today. As of the end of April, the S&P 500 is just a proxy for the broad market, was down about 5%. And that was the result of a pullback in the market of about 19% along the way. Now, what's interesting is we've talked a lot about the so-called Magnificent Seven stocks in the past, those 7 large cap tech companies that have been driving the market forward over the last 2 years in particular. But if you remove those 7 companies from the year-to-date returns for this year, 2025, the broader market, the rest of the 493 companies in the average would be about flat. So again, just some context about what we've been going through more recently. So now let's really dig into what's driving that uncertainty. What's causing the questions that are in people's mind? What's causing this period of disruption in thinking about the economy and business leaders thinking about making hiring and spending decisions? These are some of the questions that we're hearing from clients and investors. These are also some of the same questions that we believe business leaders and CEOs are facing in terms of thinking about their businesses going forward. So what we're going to try to do here is just give you a sense of how unusual has this period been, and then what have been the key drivers, and then how do we think about what that means for investment decisions going forward. So this chart shows a composite index based on U.S. economic policy sort of certainty, or the level of changes in economic policy related to tax policy or other initiatives. And that blue line is the index trying to represent the amount of uncertainty related to U.S. economic policy. You can see that blue line goes all the way back through the 1980s. It would be great if this chart went back a little bit even further. But what it really tells us is that the current period that we've just gone through, this current environment, is probably very unusual. It's at the highest level of economic policy uncertainty we've seen in the last 40 years. You can see the different time periods when there's been similar levels or spikes in the level of uncertainty or concern in the financial markets related to policy changes. And you can see how that compares with where we're at today. Now, how did we get here? So if we walk back a little bit, there were some changes unfolding at the end of last year. Over the last 2 years in particular, we've seen a lot of enthusiasm and optimism about the development of technology, especially related to AI, artificial intelligence applications. And then at the beginning of the year, there was an announcement from a competitor of one of the major AI players that sort of caused some question and concern about the level of investment that had been going into these new technologies and what kind of productivity we could all expect from them going forward. So as that announcement happened in February, we can see what the comparison looked like between the two options, the two significant options in terms of the major sort of AI languages and structures that were out there. They were relatively similar in terms of results. And then on the right-hand side, we can see a cost comparison. And this is what caused a lot of questions and concerns about one of the key drivers that had been behind the growth and appreciation of the so-called Magnificent Seven stocks over the last 2 years. So this led to the start of a period of uncertainty that started to unfold. And then as the administration sort of came into power in January, the White House got underway with some initiatives around reductions in government spending. A lot of initiatives in terms of potential workforce changes and layoffs, a lot of initiatives around cutting government aid and certain programs that have been in place for a long time. That had led to a lot of concern as well. And what we would note is that it's not just what that means in terms of reducing government spending, but there are a lot of ancillarily sort of consequences of it. Other companies and businesses that work collaboratively with some of those agencies that are also reliant on some of those same federal spending initiatives. So that's caused a lot of concern and disruption as well. If you've joined us for one of these conversations over the last 2 or 3 years, you know that we've really emphasized this issue in particular, government deficit spending and its impact on the accumulated amount of federal debt. We've emphasized that as a key concern and question mark on the outlook for the economy and for the financial markets going forward. So we've used these 2 charts in particular to just sort of demonstrate what's going on. On the left-hand side, we see the trend. The red bars are the trends of the annual budget deficits for the federal government going back through the 1990s. And you can see that for the most part, except for a period in the late 1990s, we've been in a deficit spending scenario for the last couple of decades. And then you can see the size of those bars, just the trend in those bars has been increasing, especially over the last 10 years. And then the black line on the top of that chart represents the net interest cost on the accumulated debt. And so that debt piles up based on the amount of borrowing that's needed to fund the deficit spending each year. And it's gone from a substantial, already substantial amount of, say, 20 to 25 trillion to now a level of close to 35, 36 trillion as we stand today. And with the increase in interest rates over the past few years, you can see in that black line what's happened to the cost, the net interest cost, the cost burden in terms of servicing that level of federal debt going forward. Now, at the end of last year, when we shared some of these thoughts and some of these conversations, we'd assumed that maybe this acceleration in interest costs would help crowd out some spending decisions related to the federal budget. And we didn't expect exactly how this was going to unfold this year, but it has caused some concern and it has led to a catalyst for potential change in how the government runs their budgets and the level of debt that we may have going forward. So what is the government trying to accomplish with some of these cost-cutting measures? Well, we would point you to the chart on the right-hand side, which details the level of government spending and breaks it down in a couple major categories versus the level of sources of financing. And you can see in the dotted sort of white area here, the deficit from the 2025 federal budget was on the order of $2 trillion, meaning the government spent about $2 trillion more than it received in sources of financing. That gap had to be filled with borrowing. So if you listen to the U.S. Treasury Secretary, what he's referring to when he says that we need to get to a place where the budget deficit is closer to 3% of GDP, what he's referring to is that size of that deficit today. So at $1.9 trillion on this chart, that was equivalent at the time to about 6% of GDP. So the goal from the current administration, particularly the U.S. Treasury, is to try and get that level down in half. So not trying to eliminate the deficit completely, but try to get it to a more sustainable place going forward that will then give the administration time to hopefully address the level of refinancing that needs to happen related to the federal debt. Now, the Department of Government Efficiency was also big in the headlines at the beginning of the year. We would point you to this orange section. That's really what they were trying to attack is, let's call it the level of discretionary spending in the annual budget. That bar there represents about $1 trillion. And so far, they have big aspirations in terms of what they could cut, but so far the latest numbers seem to be maybe a reduction of $150 billion or so. So this is going to be really important to watch. We would point to the budget resolution that's coming through Congress over the next few months as being a very important thing that we're paying attention to, and that will be really important for the financial markets going forward to see if we can get this dynamic on better footing going forward. So really important conversation. You take the concern about what was happening related to AI, the changes in federal spending initiatives, and some drastic cuts. Again, we can argue about the way it's being done, but some of the initiatives may be long overdue in terms of reshaping this federal budget. And then at the beginning of April, we had this announcement from the White House. Reciprocal and baseline tariffs across a number of countries and all our global trading partners. Of course, a lot has changed since the beginning of April with this announcement. This chart tries to summarize just the level of impact on sort of the overall average tariff rate that's going to be placed on U.S. goods and imports. You can see in the red dot here, that was as of the beginning of April. This gray bar that's circled here was as of the end of April. And with some recent news at the beginning of this week, the level today, the average level is probably a little bit lower, maybe close to 15, 16, 17% in terms of an estimate. Regardless of where that number settles out over time, it'll take some time to conclude a lot of these conversations with our global trading partners. You can see that it's historically unprecedented in terms of the level of tariffs being placed on imports today. This chart shows the average tariff rates each year going back through the 1900s, the beginning of the 20th century. So unprecedented level of tariffs, that's causing a lot of disruption in terms of the economy, putting a lot of sand in the gears of global supply chains, forcing businesses to rethink how they're structured going forward and how they might want to work their supply chains and their trade relationships as well. And then it's leading consumers to wonder about the impact on goods prices going forward. So this chart, especially the purple bars in the middle, gives us some sense directionally of the impact of tariffs on a number of different goods that will probably be most impacted. Again, it's a rough estimate at a point in time, and things are changing week to week, day to day, but it gives us some sense of what to expect and how things are being targeted. So whether that's imports from places like Vietnam related to clothing and leather products and other consumer goods, or it's cars and auto parts, or a variety of different things that you see on this list. So we don't know exactly where some of the impacts will end up. I'd say the good news in all this is that a lot of businesses anticipated the potential for tariffs coming, and so they imported a lot of inventory ahead of the tariffs. And so there is an excess amount of supply of inventory that businesses can work down over time to help delay the impact of potential price increases. So that's good for consumers. That should help the economy for a period of time as we transition into whatever this new trade regime is going to look like. All that said, we've emphasized this over the last 6 months. We think there continues to be upside risk to inflation going forward. This chart shows the trends and the different categories that are contributing to the headline CPI inflation index going back through the beginning of 2018. You can see the longer term trend on the far left, again, was around a 2 to 2.5% goal. That's the long-term goal as sort of indicated by the Federal Reserve. And you can see where we stand today, a little bit above that average. Things have been moving in the right direction after significant interest rate increases a few years ago to help bring down inflation. But it'll take time to settle back into where the longer-term trends were before. And the disruptions related to tariffs and all the uncertainty that's been going on will for sure put upside risk to the inflation levels going forward for an extended period of time. Nobody knows for how long for sure. That leads us to this conversation, which is, as the headline of the chart describes, we're in a period where economic growth is slowing. The level of imports that came in during the first quarter actually caused first quarter GDP numbers to be negative, slightly negative in terms of quarter over quarter growth. Our industry defines a recession, a technical recession, as 2 quarters of negative GDP growth. So we're in a period where the economy was slowing down a little bit at the end of last year. The level of uncertainty that has picked up, the dynamics around trade, even in the first quarter, are really bringing the economy to a slow or sort of stall speed and stagnating. And then at the same time, we have inflation risk still a little bit above long-term goals and averages, and if anything, a little bit elevated with some potential upside risk. So to us, that leads us to, sort of a suggestion that we're probably going to be in a stagflationary type environment, slow economic growth, potentially rising inflation for a period of time. And we will want people to take away from this chart is that in prior periods that were similar to this, where it saw similar outcomes in terms of economic growth and inflation, there was a dramatic difference in the pattern of returns from different asset classes and investment categories relative to what we've all been used to for the last 30 years. So on the far left-hand side of the chart, you see returns across a number of different investment categories and asset classes that are color-coded there, early 1930s. In the middle, you can see the early 1970s, and then towards the right-hand side, you can see the early 1980s. And then the chart on the right-hand side tries to average out each of those different 13 sort of observations, those 13 different calendar years. And you can see the dramatic difference if we just look at that column labeled average across those time periods that were more stagflationary. Gold was one of the top performing asset classes, whereas US large cap stocks, which have been one of the best performers for many years now, was one of the worst performers during those types of time periods. Now, we should never read too much into historical returns. The economy evolves over time, the world changes. But again, as the title of the slide points out, the pattern of returns during periods like this, these stagflationary periods, is different enough that we are considering of thinking about where we might end up as trade negotiations conclude, as other events play out, to see where we might be going forward and if there might be the opportunity to change how we approach our asset allocation decisions and how we provide diversification for clients. With that in mind, we wanted to also share sort of our updated forecast about annualized return expectations. We go through this exercise at the beginning of every year, sort of updating our long-term risk-reward forecast for a number of different asset classes and investment categories. These are 10-year estimates, and they are just that. They are just estimates. But we take into consideration a number of different factors, most importantly, where valuations are at for these different categories, where the level of yields are at, where spreads are at, a number of different risk factors that we consider. And over time, we've been sort of continuously reducing our expectation for forward return expectations for things like US large cap stocks. Hopefully that makes sense. Again, as US large cap stocks have performed really well and valuations have moved to above average levels, we should all expect that as when prices are high, forward returns or future returns are likely to be lower than average. So this is important consideration as we think about that last chart that shows a different sort of pattern of diversification benefits from different asset classes. Put that in conjunction with a different dynamic in terms of expected returns going forward. And this is something that we want to make sure that you all are appreciating and aware of, and that we're having good conversations about your long-term goals and objectives, your plans, and how the world may be changing and the investment opportunities and asset allocation decisions may be changing as well. We want to make sure everyone's thinking about this. This is not a forecast in terms of a specific expectation. This is just an estimate and kind of our views. But again, with all that in mind, we think it's a great opportunity for all of our clients to be talking with their advisors to make sure that we're on the same page in terms of their goals and objectives and how they want to build their plans going forward. Okay, let's switch gears and talk a little bit about what's going on in the stock market, and you can think of this a little bit more about risk assets in general. So as all of this uncertainty unfolded, this was sort of the picture of what's going on broadly in the global stock markets as of the end of the first quarter, so right at the beginning of April. On the left-hand side, we see the trends in global earnings across a couple of different geographies, the US, China, Japan, the Eurozone, emerging markets. They're all color-coded, going back through 2006. And what we tried to highlight there in the red arrow is what happened to US sort of aggregate earnings coming out of the COVID recession in 2020. You can see how dramatically US earnings in aggregate outpaced the rest of the world. So that was really good news in terms of helping to support stock market returns related to that earnings stream. The challenge has been that's left us in a place, as you can see on the right-hand side, where valuations, this is based on forward next 12-month price to earnings ratios, valuations for the US stock market are now at above average levels and at the higher end of their 25-year range. So the gray bars there represent the ranges of price to earnings ratios over the last 25 years. The purple line represents the average, and the dots show us where we are at the end of the first quarter and where we began the year. And when you look across those geographies, you can see that the US, of course, is trading at well above average levels and at the high end of the range, whereas the rest of the world is trading at either average or to below average levels compared to where the US is at today. We think this is really important as you think about the change in the dynamics around fiscal policy or government spending. Here, what's happening in the US relative to what's happening overseas, particularly with Germany, leading the way with some significant spending related to infrastructure development and military defense. We think there's a dramatic change going on here in the level of fiscal impulse supporting different economies between the US and Europe, for example, as elsewhere in the world, where that could change the pattern of earnings growth that we might see coming out of this environment. So we want to keep that in mind as we think about starting valuation levels where we're at today and what to expect in terms of future returns. So to try and make a little bit finer point here, we think the US stock market, generally speaking, large cap stocks in particular, look relatively expensive today. Hence, we're a little bit more cautious on the outlook for them. But when you look overseas, the rest of the world has been attractive, trading at below average price to earnings ratios for a long time. And now we think there's a potential catalyst, especially with the change in government spending, the movement in the dollar relative to other currencies, and the level of interest rates. So we think this is a really good reminder that there's an opportunity here for diversification and potential return improvement across our asset allocations when we look outside of just the US stock market. Now, drilling a little bit further, we put together this chart in a similar format from the last one just to make it comparable. But outside of the US, especially outside of US large cap stocks, there are plenty of other interesting places that we think are attractive and that we have been taking advantage of in very small tactical ways during this recent drawdown. On the far left-hand side, we see the Russell 2000 or US small cap stocks. Then we see Russell 1000 growth. You can think of that as large to mid cap growth stocks. Then next is large to mid cap value stocks. And then last on the far right, you can think of that as international developed small cap stocks. And again, similar comparison to what we just described, but small cap stocks have already been in a bear market for a period of time. They're down from their peaks back in November of over 20%, and valuations, starting valuation levels from here in terms of forward returns, are relatively attractive compared to the historical averages. Cyclical stocks, especially those large to mid cap value stocks in the Russell 1000 value, look a little bit more interesting relative to their growth counterparts, as we can see in the two bars in the middle. And we've been leaning into that in terms of some portfolio and tactical decisions as well. That could be companies that are more economically sensitive, like financials. It could be companies that have a high quality bias, but are in industrial sectors where there's a little bit more cyclicality. So we've been taking advantage of that. And then lastly, on the far right, international stocks, just like we saw on the last page, broadly speaking, have been cheaper and relatively more attractive than US stocks. And that's even more true in international small cap stocks today. So a couple of different areas where we see some relative opportunity compared to the level of valuations and potential returns that US stocks are providing today. The challenge is this. So this chart describes the percentage of overseas sales across the number of different US sectors. This is within the S&P 500. And then breaks down where those sales are going in terms of overseas exports. So this leads to some complicated discussions around what might the E in the price to earnings ratio, what might the earnings level be going forward? Given all the sort of macro changes happening around global trade policy and tariffs, when you look at this chart, you can easily make some assumptions about how difficult it's going to be to settle into what is the right level of expected earnings for the stock market in general in the US going forward. Think about the tech sector on the far left, almost 60% of sales overseas. That comes in a variety of different forms, and you can see the different countries that it's going to. So global trade dynamics, changes in supply chains, tariffs will dramatically affect what the forward outlook for earnings for any company in that sector might be. And then just as an example, on the far right, you can see financials, real estate, utilities, more domestically focused, less export revenue. So it's a little bit easier in those areas of the market to have a better sense, a better level of confidence in terms of what earnings levels might look like going forward. But in this type of environment with so much uncertainty around tariffs, global trade changes, it really leads us back to one fundamental sort of part of our investment philosophy. And if you've been with us for a long time, you've heard us talk about this year in and year out, but we really have a bias towards high quality companies. We really have a strong bias towards a bottom-up fundamental approach to making the investment decisions about which companies we think are going to be good compounders and potentially provide great returns for our clients going forward. We think that's really true in this environment today with so much uncertainty around where earnings levels might end up because of what's going on. That leads us to this analysis. So this is a representation of a company's life cycle, starting from the left-hand side where a company may be starting out, entrepreneurial startup phase, rapid growth, maybe a little bit less level of profitability or returns on investment in the business. Then moving to a compounding phase where the business starts to reach some level of maturity. It's generating really significant returns from the investment in its business. Then it might progress down the life cycle into maturation or renewal. Some different businesses go through this process faster than others. And along the way, it may reach a really fully mature stage where it's sort of at a steady state in terms of the level of returns that its business can generate from continued investment in it. We've plotted here 4 different consumer-oriented companies to help make this exercise and this explanation a little bit easier. We can see a company like Carvana on the far left. It's in a rapid growth phase, in that accelerating phase. TJ Maxx, a retailer in the middle, Five Below, a discount retailer, moving from left to right. And then Macy's, a traditional department store chain that probably many of you are familiar with on the far right. So each business is at a different place in its life cycle. And what we think is really important from this bottoms-up perspective is understanding the key business drivers for each of those companies and what it means in terms of how they're going to continue to generate value for their shareholders going forward and continue to compound returns in their business. Now, we picked these companies intentionally. We only own one of these companies in our core stock portfolios, and that's TJ Maxx. What attracted us to TJ Maxx originally is displayed on this chart. This is what our analysts look at every day. This is the proprietary tools that we've built, and there's a lot of graphics here to understand. But on the left-hand side, it really shows us at the top of that panel the level of economic return being generated from reinvestment in the business. We were attracted to TJ Maxx some time ago because of the consistent level and the increasing level of returns that they were generating from continued growth and reinvestment in their business. And that shows up in that bottom left panel in the relative return, that green line, relative to their peers. On the right-hand side, we see a number of different fundamental characteristics, sales growth levels, profit margins, and so on. But these kind of tools helped us identify TJ Maxx some time ago. One thing that helped generate their strong level of economic returns within their business is their very unique supply chain. So they're a retailer focused sort of on let's call it an off-price channel. And they source most of their merchandise very locally and domestically, meaning it's already been imported here to the US, and there may be off-price channels, wholesale channels, or closeout discounts from other channels where TJ Maxx opportunistically builds its merchandise inventory for its consumers. So that's a huge, important differentiator that we identified as part of the opportunity for why TJ Maxx was continuing to win market share and continuing to perform well in its industry. And sure enough, in this environment, TJ Maxx has continued to benefit. On the first day of the announcement of the tariffs back on April 2nd, TJ Maxx was one of the only companies in the consumer sector that actually saw its stock price increase. So we think it's a great example of bottoms-up fundamental analysis where we can have a lot more conviction and confidence in the outlook for a specific investment rather than from a top-down perspective where there's a lot of questions and remaining uncertainty to be resolved around what's happening with trade, what's happening with federal debt and the budget deficit going forward. Okay, we'll start to wrap it up and just talk a little bit about where we were at the end of last year, how we've been positioned and what we've been doing in this environment as things have unfolded at the start of the year. So at the end of last year, we were, generally speaking, reducing risk across our allocations and within portfolios. We were taking advantage of some opportunities where we saw some relative attractiveness start to develop, like in small cap stocks or in bank stocks. But for the most part, across the core part of our asset allocations, we were reducing risk. It wasn't because we saw this coming. It was really because as we looked at what had happened over the last few years and the level of returns, broadly speaking, across the stock market and what that has led to in terms of valuations for large cap stocks in particular, we go through our process, and that to us just meant that future returns, forward returns for stocks were going to be lower. Similarly, for bonds, as we think about the level of yields, especially for, let's say, corporate bonds, the level of yields relative to treasury bonds, those differentials, those spreads, so to speak, have been really tight. So we've been reducing risk in certain ways in our core bond portfolios. We now hold less corporate bonds than we've ever held in the past because of the level of yields there. The yield differential on corporate bonds was just not attractive enough to continue to hold more of those positions. What have we been doing during the drawdown after we reduced risk at the end of last year? In some places, we've continued to reduce risk. In other places, we've looked for the opportunity to upgrade portfolios. That could mean individual company decisions around moving from one stock that are performing really well, but maybe had reached sort of the end of where we think it might be able to accomplish in terms of appreciation, and moving to a really well-managed business at a much better price in today's environment. We've continued to move to take advantage of what we think is going on in Europe with the change in federal spending dynamics and fiscal impulse, and continue to build our position in European stocks. We've been harvesting volatility for the benefit of clients, which will help reduce after-tax returns coming out of an environment like this. And we've continued to think about that chart that we showed earlier about where we may be going forward, what the conditions may be in terms of economic policy, fiscal policy, monetary policy, and what that could mean in terms of how we build our asset allocations and provide diversification going forward. Now, what to watch? We're getting some resolution on some of the trade negotiations. That's moving relatively slowly, and there's news each week about different changes and different outcomes. And of course, we want to continue to watch that going forward. What's more important is how businesses are responding. They've had to deal with this quickly as the initiation of tariffs, especially in Canada and Mexico and overseas. Businesses have had to respond even faster before they could let these trade negotiations settle out. So they've been changing their supply chains. They've been working with different vendors. They've been thinking about how to continue to provide the services and goods that they provide to their consumers. And we think that's really important to watch going forward, regardless of sort of the high-level negotiations between countries. We think this risk has been reduced, especially with the news earlier this week related to good progress on negotiations between the US and China. So the probability that it could turn into an escalated situation and potentially military conflict, that risk seems to be going down, but something that we'll continue to watch going forward. All of this then leads to the Federal Reserve's response. What will they be able to do in this environment where inflation has an upward risk bias to it, economic growth is slowing, and maybe the labor market is weakening as well? So we saw in their recent announcement that the Federal Reserve will continue to be patient based on incoming data and will be slow and sort of gradual in their approach to thinking about interest rate targets or other forms of potential monetary policy changes as well. Most importantly, I mentioned this earlier, but we all need to pay attention to the legislation coming from Congress and how that will impact the outlook going forward. There's a lot of discussion around extending the previous tax cuts that were put in place during the first administration, the first term from this administration. But in order to do that and make it relatively budget neutral, some other things will have to give. There hasn't been enough spending cuts. There hasn't been enough tariff revenue generated. So something will have to change in the dynamics between taxing and spending to make some of those individual tax rates more permanent going forward. And then lastly, we talked about this at the end of last year, but there hasn't been a lot of focus on it in the first 4 months of this year. And we think as some of the macro news settles down around trade and other things, people will come back to realize that this administration, one of the benefits has been a significant increase or decrease in the amount of regulation applied to different industries and businesses. So that movement back towards, let's call it a deregulation or a deregulatory environment, is really good for businesses, and it should create some opportunities in different industries where there's consolidation potential and opportunities to continue to change the competitive landscape going forward. Now, with all that in mind, we're also paying close attention to some of these key financial market indicators. The way to think about this chart is on the left-hand side, we've got US stocks and US, let's call them high-yield bonds or riskier bonds, not investment-grade bonds. Those are risk assets. In the middle, we've got 2-year Treasury bond yields and 30-year Treasury bond yields. And on the right, we've got the US dollar and gold prices. And you can see the trends. This was from the beginning of the year through the end of April. And you can see how risk assets behaved on the left, pretty similarly in terms of the drawdown and the recovery through the end of April. But you can see a dramatic difference here between what shorter-term bond yields were doing versus longer-term bond yields were rising. We look at that signal, the difference between those two, in conjunction with the dollar declining and gold prices rising. That tells us that there was a fair amount of concern about a potential crisis related to the federal debt level and deficit spending. So we've been watching this very carefully. The US Treasury in particular, we think is being very thoughtful with a plan to help address this. But these are some of the signals that we're watching moving forward to see how the markets react to some of those changes and initiatives, especially the legislation that's still pending from Congress. So we'll wrap it up here and then we'll open it up for questions. But just a reminder that in this kind of environment, no one can predict the future. There's too many variables at play. There's too much uncertainty. This is not a time to make big bets. This is a time to stick to the plan, the longer-term plan, trust in the goals and objectives that you set and the asset allocation that you built, but make sure that you're prepared, depending on how the outcome plays out, that you can take advantage of opportunities. And in that sense, liquidity and or dry powder, your safety net portfolios in terms of high quality bonds are really important in an environment like this so that you can be prepared to take advantage of opportunities if and when they present themselves. We haven't been in a rush to rebalance client allocations along the way. Typically, when we go through a downturn, an extended bear market, we want to make sure we're repositioning risk allocations along the way. Given the level of uncertainty, we've been sort of taking that very gradually, especially for clients with lower risk profiles. But for all clients, we've been continuing to tactically rebalance within asset classes and continuing to reposition individual portfolios. And this last bullet point, I tried to emphasize it in the last section as well, but it's really important. We have so much more conviction, a stronger level of confidence when we're making individual company decisions that bottoms up fundamental analysis compared to the macro views. So that gives us confidence when we're thinking about rebalancing from, let's say, bonds back into stocks, to know what we own and know that they're really high quality companies and should continue to do well regardless of the macro environment and the outcome of some of these trade dynamics going forward. Okay, thank you. One last question, one last slide here. I forgot about this one, but as we think about this, one of the most important things is, again, to work with your advisor and kind of help them understand your goals and objectives and make sure that they can help you on this emotional journey that happens through every market cycle. This chart just sort of displays the natural changes in emotions along the way from the beginning of a market cycle to the peak, and on the way down to the trough in terms of renewal, in terms of the next cycle going forward. It's really important. We provide a lot of value. Our advisors do a great job working with clients to continue to reinsure them to stay the course and stick with the plan that they've built. But we want to make sure that you're all well prepared and everyone's in a position so that if you reach that trough where emotions are really high and there's a lot of concern and people are in fear or panicking, that we don't sell out at that point. What's often been the case is that when things look the worst, those tend to be the best buying opportunities long-term for good long-term investors. So with that, I'll bring Dimitri back on and we can open it up for questions.
Thank you, Chris. Excellent job. The material is always really insightful. I hope the audience here feels the same way. We did have a number of questions come through. I've done my best during the call to try to consolidate some of these questions because they do have some similarities. The very first one is just a housekeeping question. Somebody in the audience asked if the material and the slides are going to be shared. The answer to that is yes. If you've registered for this webinar, the recording will be sent to all those who've attended or have registered. So you can review that material and share it with your families. All right. So the first couple of questions, come from Washington. Given what we've experienced thus far from Trump's second term in the White House, are you and your team revisiting your asset allocation and investment guidance for the next 4 years?
Stop sharing my screen there. Yes. Yeah. So great question. We're hearing that a lot. And hopefully we articulated a good chunk of that, but there are a lot of variables that are changing. It is possible that we come out of the other end of this period of uncertainty with a different outlook than what we've had for what investments are going to work best for clients than what we've had for the last 30 years. So we're really trying to take that into consideration. It's too early to say exactly what the new environment may look like or if there is a dramatically new environment. But we think it's important that people keep that in mind and take it into consideration as they think about their investment plans and their asset allocations going forward. Over the next 4 years in particular, right, this administration's getting up and going. The next budget bill is going to be super important. The next round of midterm elections are going to be super important to watch as well to give us some sense of where this administration might end up 4 years from now.
Right. Similar, from a more of a macro level, one of the areas that this administration has been very focused on is cutting funding for larger institutions or universities, research and development projects. Do you think that this will impact our ability as a country to be innovative? And one of the key economic measures that we always focus on is GDP. So what impact do you think that could have should some of these negotiations change what the future looks like for these bigger institutions?
Yeah, it's a great topic, and there's been a ton of press and headlines around what's going on there, in particular with the administration's challenge related to Harvard's tax status. So Harvard is a really interesting example. Again, a very successful institution for a variety of different reasons. They have a very large endowment, over $50 billion. So it's really an interesting dynamic. The controversy between Harvard and the administration has more to do with different policies, but it's really the ultimate question when you look underneath the headlines is, should an institution like Harvard continue to get a tax-exempt status rather than be taxed like any other corporation? Regardless of the outcome of that, I think innovation will still happen. It may move to different places, or the way it's get done may still change a little bit, even if it stays in these larger institutions. And people will have to adjust along the way. But one great thing we know about the US economy over a long period of time is that the growth of the economy is really driven by a function of productivity, sort of the population growth plus productivity changes. And the US economy has, more than any other country, shown a really continued success in driving higher productivity. To that end, if you think back to the conversation related to AI, if anything in this environment with this period of uncertainty, and if we do have a sort of slowdown in the economy that is technically a recession, if anything, corporate and business leaders, institutions will probably move to adopt new technologies like AI faster. And so that'll help just the global economy, in some sense, the US economy for sure, in continuing to drive innovation and productivity going forward.
Makes sense. One of the slides that you spent a lot of time on was the federal deficit in this country, and there's similar situations around the world. A question from the audience: long-term government debt yields have been rising of late. You emphasize that as sort of a warning signal in one of the slides that you shared towards the end. But when it comes to, individuals and families and their investment strategy, can you speak briefly about fixed income strategies and, with respect to how we're managing interest rate risk?
Yeah, it's a great question. Given the volatility in the level of market interest rates and treasury bond yields, it's something we pay very close attention to. For our clients, almost all of their, let's say, core bond portfolios have a relatively short to intermediate duration, meaning the range of maturities is maybe between 1 and 10, or maybe out to 12 years. So the changes in the volatility at the longer end of the maturity spectrum doesn't affect the price movements or the volatility in our individual bond portfolios that much, but we're paying very close attention to it, because if there are dramatic changes there, if there isn't some resolution to the level of deficit spending, if there isn't comfort about the amount of federal debt going forward, that could add an incremental risk premium on top of current level of US Treasury yields. That may be different across different size, different length of maturities. It's something we're paying attention to, but we're trying to manage around that very carefully. Again, this question has often been followed up by, well, how much of US Treasury bonds are owned by foreigners? How much does China own of US Treasury bonds? Well, the last numbers we saw was that China owned roughly 800 billion out of the 36 trillion dollars of federal debt. Now, that number isn't perfectly accurate. There are different ways to break it down, but the dynamics there in terms of the different owners of US Treasury bonds globally, everyone's paying attention to it, and there are sort of natural ways where yields and the price of those assets could find different equilibriums over time. For example, insurance companies in aggregate in the US only own about 1% of US Treasury bonds that are outstanding today. So there may be a natural process where buyers and sellers sort of set a new market clearing price, a new level of yields, but we'll see. That it's too early to say that anything dramatically there will change. The legislation coming from Congress will be really important to pay attention to.
Thank you. So our organization, as we shared at the onset of the call, is prepared with wonderful advisor teams and resources across the country to help our clients everywhere they are in their financial journey. For individuals and families and clients of ours that are in retirement, about to approach retirement, and will rely on their portfolios and their IRAs for automatic withdrawals and distributions, are there any proactive changes that should be taking place in those asset allocation profiles, given, what we feel the new environment will look like?
That's a great question, and our advisors do a great job talking with clients in those situations about exactly that. As people are approaching, let's call it major life changes or events, it's definitely a great time to reevaluate the plan and your asset allocations and the level of risk you're taking with your investments. So if you're getting closer to retirement and you're concerned about the outlook for the economy or for the financial markets, it may be appropriate for you to take less risk in your portfolios, take less risk in your overall asset allocations. But that's a really great conversation to have with your advisor, help them appreciate your questions, concerns, what your objectives are, your timeline, how close you might be to retirement, what level of spending you might want to achieve in retirement. All those different factors go into it. And that's one of the great things our advisors do in terms of helping clients navigate those questions and come up with the right plan longer term.
Right. So you mentioned this twice in the presentation from your very first slide. where you highlighted that if we look at the US S&P 500 as one of the key gauges for, stock market returns, there have been multiple periods over the years where we've had 10, 12, 15-year periods where the markets have basically been flat as measured by US large cap stocks. Then you shared what I think is also one of the more powerful slides in the deck, the color-coded boxes that show the different return levels of different asset classes in stagflationary environments, the 1930s, the early 1970s, the early 1980s. For me, what's been interesting about that is it's likely, most people in the audience weren't even born yet in the 1930s. And then most probably weren't even investing yet in the 1970s or early 80s, or they were just getting started out in their careers. So with all that said, there are obviously, in those environments, changing the composition of an asset allocation was important. Inside of our firm, we've talked about clients broadening their diversification. But three different types of investment asset classes that either weren't available back then or weren't available to the general public were investments in like private equity, in hedged strategies, and now a more recent phenomenon, cryptocurrencies and Bitcoin. What role do those three sort of asset classes play in the framework of one's allocation going forward?
Great question. It's a very important consideration to think about too, as the financial markets has changed, as the investment landscape has changed. So it was private equity, digital assets, cryptocurrencies, and hedged, or let's say, alternative assets. So private equity in particular has seen dramatic growth in the number of managers and the number of capital that's being put behind private transactions related to different businesses over time. We pay very close attention to that as it can influence the outlook for returns from those private investments. Those private investments in businesses and even in private real estate, for example, often can generate a higher level of return in some cases compared to the public markets. And so those private investments are really important to consider as part of the overall plan for generating the right level of goals and objectives for your plan longer term, as well as providing some less correlated returns with the traditional markets like US stocks or public US stocks and bonds. Hedge strategies, we've seen a lot of change over the last 20 years in the utility and sort of the productiveness of hedge strategies in an asset allocation. There was a period of time where they were very successful in helping to generate good returns with less risk than, say, public stocks. There's a period of time where they were less productive. But in the current environment, very sort of straightforward hedge strategies may be very, very helpful in helping to provide some diversification and less correlated returns with the rest of our assets within an asset allocation. Those could be things like simple arbitrage strategies. They could be a little bit more complicated, but are becoming much more useful than they have been, say, over the last 5 to 10 years. So it's a very important consideration going forward. And we have great partners to work with on that front as well in terms of providing recommendations for clients to consider. And then the last one is just, let's call it digital assets or cryptocurrency. Very early stages of that category of investments, that category of assets still developing. Good advancement and progress in the availability and the accessibility of investors being able to access them more efficiently. It's still very early to understand how those assets, let's call them digital assets like Bitcoin, behave in environments like this, or like they might behave going forward. Because a lot of the growth and the value of those digital assets has been a function of their early stage of development and sort of enthusiasm and adoption in the industry for digital assets going forward. For example, gold prices moved higher at the beginning of the year, whereas Bitcoin prices moved lower. So if anyone thought of Bitcoin or digital assets as a form of digital gold or a diversifier in asset allocations, it may still take some time to prove that case out. We think it's interesting. We're optimistic about the long-term opportunity in digital assets, but with some uncertainty around how they'll behave longer term, we're very cautious in terms of the size of the allocation and clients' portfolios to digital assets going forward.
Thank you. We have one last question. It's along these same lines. what role does inflation play in market reactions, as well as, how that's tied to increased federal spending? And if these deficits continue to fuel inflation, which sectors do you believe are the most vulnerable, and which ones benefit the most from an investment perspective?
Yeah, it's a great question. I'd start by saying if you follow the monthly releases around the consumer price index or even the producer price indices, it's still early to see any impact from the changes in trade dynamics or tariffs. The last number that was released around this, the consumer price index, was still fine. There was no real observable impact from tariffs just yet. But as that changes over time, if the tariffs remain on average at a relatively high level, and that puts upward pressure to inflation numbers that are being reported, it's really important to think about what type of companies and businesses have pricing power. And it's also important to think about what types of companies and businesses have, let's refer to it as the ability to weather the storm, right? Either that means they have a really strong level of profit margins today, so they can absorb some of those price increases, or they have really strong balance sheets. So if they choose to absorb it, they can help continue to fund their businesses going forward, even if the level of their profitability goes down. So sometimes that means bigger players in the industry. Sometimes it just means better businesses with better pricing power and better competitive positioning. But our analysts, both in our equity and fixed income teams, pay close attention to that for companies and industries where those characteristics in terms of absorbing or weathering price increases without necessarily passing it on to consumers could be more beneficial to investment returns going forward. The inflation levels are also super important to the Federal Reserve, right? The Federal Reserve's dual mandate is around full employment and let's call it modest or reasonable levels of inflation, 2 to 2.5%. So as the inflation readings change over the next couple of months, the Federal Reserve for sure will be paying attention to what that means for the direction of their monetary policy going forward.
Great. Well, Chris, thank you for all that insight. I would like to thank the audience for your participation, for spending time with us today, for your questions. We plan to keep our communication elevated as we see more clarity on these global trade negotiations, what tax policy could look like in the coming months and throughout the rest of the year. But thank you. Thank you for all of you who've been part of the Curi RMB journey for the last 20 years. We look forward to the next 20, and we hope to see you next time. Thanks a lot.
Thanks, everyone.